Hey, we're coming to you from Full Global Headquarters in Alexandria, Virginia. I'm Chris Hill, and I'm joined by Senior Analyst Bill Mann. Thanks for being here.
I'm sitting way over here, Chris.
We are practicing the social distancing here in the studio.
Yeah.
We're going to be talking about where to invest $1,000 right now. We're going to be taking your questions. Bill's got 3 stock ideas that you can put on your watch list. And if you're looking for even more stock ideas, just go to fool.com/2020. You can get Tom Gardner, Motley Fool CEO Tom Gardner's recommendations for the year ahead. Let's start, before we get to your stocks, let's start with the market writ large. I've been watching a lot of financial television lately. You got a few people on there talking about like how cheap the market is.
Yeah.
It's certainly cheaper than it was a couple of months ago, but do you look at this market right now and say the whole thing is cheap?
No, I don't actually. I think it really bears remembering that 12 years into a bull market, call it, that the market was actually really historically expensive coming into February of this year. It is, of course, much cheaper than it was. A really great measure to talk about the relative valuation of the market is called the Shiller PE ratio, which is a capital adjusted PE ratio, and it takes 10 years worth of back data. And at its peak, even a few weeks ago, it was 32, 33, and now it's at 22, which is historically still above average. So yes, I mean, I think that now there are definitely opportunities out there. As you know, we here at the Motley Fool don't really say buy the market or don't buy the market. We're going to focus on companies themselves. But if you're looking just for a straight opportunity in the market, I don't think it's here yet.
So it's not available for the market writ large, but when you look at particular industries, are there ones that are starting to look attractive? Certainly oil stocks have gotten hammered, but I don't know of anyone, including you, who thinks they are so cheap right now that they're attractive.
Yeah, no, obviously the energy has been hit amongst the hardest. I think if you did want to get exposure to the energy, to oil and gas stocks, the way to do it would be to buy the largest of them, because what's inevitably going to happen in a capital intensive industry like that is that the weaker companies are in real distress. So a lot of those properties are going to be bought at bargain prices. There's no way that I would dare call the bottom at this point, and there's no way that I would dare say it may not get a lot worse, but that is an area where people have run, screaming from. So there may be some opportunity there, but I would stick with the biggest names. It's noteworthy that ExxonMobil decided to slash their dividend because they're hoarding cash for something.
Absolutely, and we've seen businesses across any number of industries who have cut their dividend. We had Ford Motor coming out earlier today suspending their dividend.
Yeah,
Darden Restaurants, parent company of Olive Garden and Longhorn Steakhouse. Are there industries that you do think look more attractive? And also, how are you finding them? What are the 1 or 2 metrics that you're using to determine what's a value play as opposed to a value trap?
So from an industry perspective, there are companies in the entertainment industry, and we'll talk about some in a little bit. One of the things that I've focused on is not necessarily on an industry by industry basis, but focusing on companies within certain industries that are the strongest, that have the strongest balance sheets, that do not have the same level of capital reinvestment requirements. And those are the places where you're going to find opportunities, because as we've seen on a day-to-day basis, the market is being sold off or bought, in the aggregate. There really are very few companies that are, when the market goes down 10%, there are companies that are going down 6%, but there's, very few companies that are actually going up.
One more thing on the dividend slashing that we talked about. Always worth remembering that we like to focus on businesses, but human beings run these businesses, and CEOs are responsible for capital allocation.
Yeah.
When you look at whether it's ExxonMobil, Ford Motor, or any other business out there suspending or cutting their dividend, do you automatically give them the benefit of the doubt? Because in the case of some of these companies, they've been paying a dividend for a long time.
I do in this instance. Really, what we're going through right now, the only real allegory that I could think of, the only real comparable is, was September 11th in 2001, because when you go back and you look at market crashes in the past, I mean, Ben Bernanke is an expert in the Great Depression, and they're still debating what caused the Great Depression, and we are now 91 years later. We're talking about what caused the crash in 2008 and 2009. Those sorts of things we think we know, but we're not quite sure what caused what and what caused everything to cascade. In this situation, we know exactly what the problem is, and we know exactly what the solution is going to be, and the solution is going to be economically painful for a lot of companies. And so for companies to come out and say, we are hoarding cash right now so that they can continue to pay employees, so that they can, so that they can take some advantages, I have to applaud it.
Let's get to the stocks. Obviously, a lot of industries out there are getting hit. There are a lot of businesses that have just, frankly, too many X factors when you think about the next 6 to 12 months. As foolish investors, we like to think in terms of decades and not months.
But here we are.
Here we are. You've got 3 stocks. What's up first?
The first of which is Disney. And Disney, as we know, 30% of their cash flows come from their parks worldwide, and the parks are all closed right now. But Disney was a stock. This may be a really good, a really good case study, because Disney has come down very sharply from its peak, and it was actually dropping rather sharply even before the beginning of the coronavirus. But Disney as a company, at the end of the day, has such unbelievably valuable assets, and has a great cash position, and they have expenses that they can cut back on, and they do have things that people are going to continue to consume. So Disney, I think, is a company that is much more exciting as an investment than it was even 2 months ago.
Before we get to your next stock, I got to ask you about one piece of the Disney empire, and that is their cruise line, because almost no industry has been hit as hard as the cruise line industry. Royal Caribbean, Carnival Cruise Line. Do you when you look at that industry, do you put Disney off to the side because they have other business lines that are more meaningful?
Yeah, they are of the cruise companies, the companies that have exposure to cruises, almost unique in that regard. I assign value to cruise companies of somewhere close to 0 now, and simply not because I'm saying they're all doomed, but if the worst case tenors, the worst case duration of the shutdown, and the slowdown continues, the cruise companies are in a tremendous amount of trouble. And because they are flagged in places like Panama and Liberia, there's no really, there's nobody who is really either capable or willing to bail them out. Disney's cruises, I mean, obviously they're in the exact same boat. Pardon the pun. But they are, in fact, a little bit different, simply because it is such a small part of the Disney of the Disney empire.
All right, let's move off of Disney and cruises. What's your second stock?
My next one is Starbucks, and Starbucks got hit really hard. They have an enormous amount of stores in China, and all of those were closed. They are beginning to open back up. That stock has been essentially, it had been cut in half. At this point, it's it's up a little bit. It was the high of the year was about 100, and it's at 60 now. Tremendous franchise, absolutely addictive product. It's something that people, when they go out, when they do venture out, now a lot of times it is to go and get that cup of coffee, a little bit a little bit of happiness in their day. So Starbucks is a company that I believe is going to come out on the other side very, very strong.
You look in the private markets, JAB Holdings is a company that bought up a bunch of companies that used to be publicly traded, Caribou Coffee, Peet's Coffee, that sort of thing. There was talk that they might be spinning some of those out. I would also point out JAB Holdings also owns Panera Bread. Is it safe to assume that the IPO market and spin-offs of this nature are completely on hold at this point?
Gosh, that's a super question. Functionally, I don't know how you would go through the process of doing it, given social distancing and given all of the things that have to happen for companies to actually do a spinoff. I would suspect that there may be ones that are done in under duress and under negative circumstances. I don't know the circumstances of JAB by itself, but if they do need capital, you may see them spinning out some pretty valuable assets. Things like that absolutely did happen in 2008 and 2009.
All right, we got a lot of great questions coming in. We're going to get to those in just one second. What's your third stock?
The third stock may be a little bit of a surprise. It's actually JD.com, which is a Chinese company. They recently announced that they're doing a $2 billion buyback. A lot of people might not know this, and this would be a surprise, that the Chinese stock market is the best performing so far in 2020, and has been for several weeks now. JD.com actually got its start during the SARS crisis, 15 years ago. They had a number of stores and they shut them all down and they went all online. It is essentially where people get their goods and services in China, and they have gone through the process of spending billions of dollars setting up all of their own infrastructure. They do their shipping themselves. They do everything internally. So it is what David Gardner loves this word. It's a Nicholas Taleb word. It's an anti-fragile company, and it's the stock has not actually come down that much during the crisis, but it is. I think at the end of the day, one of the things that that we are looking at and where we're going to find opportunities is habits that get formed now that don't go back afterwards. And I think for JD.com, they really have the potential to become a much larger player in China than they are now.
All right, if you're enjoying the video, please, as always, give us a thumbs up. It helps other people find the video, and we like doing these videos. And again, go to fool.com/2020. You can get Tom Gardner's recommendations for the year ahead, in addition to the 3 stocks that you just heard from Bill Mann. Let's get to the questions. Julie asking, do you think it's better to invest in more growth stocks if you're in it for the long term instead of recession-proof stocks? Great question, because we've talked in the past about those businesses like waste management, just to name one, that is literally in the business of collecting trash. That's a business that's going to go on whether there's a recession or not. Yeah. But to Julie's question, if you've got a long time horizon, would you be looking more at growth stocks and then the waste managements of the world? I would be, but there's a difference between different types of growth stocks, and waste management is a great example of maybe a non-growth stock that I would look at. Costco might be another one that people don't consider to be a growth stock. Where companies are going to come into trouble is ones that require a lot of additional capital to either grow or for their basic operations now. So the airlines will need more capital. Growth companies that have had to tap the public markets or the debt markets, they are in some trouble now. But companies that really don't require a lot of additional capital, those are the kinds of companies at this point that I'm really excited about. A question from Josh, who asks, any buying opportunity in airline, cruise, hotels, and retail industries that suffered the most so far? Boy, you think about most of the industries that Josh name-checked there, and it really is such a rough time for travel and tourism. If you were going to buy in that segment, the answer is probably. And if you want to sound like a genius, you would say yes. Yes, because this segment has gotten hammered. And a lot of people have been wondering what Warren Buffett is doing with Berkshire Hathaway's $140 billion cash hoard. And one of the things that I believe we may find out that that they have done is to backstop some of the airlines, maybe through a preferred purchase. That may not help the shareholders all that much because the preferred would have seniority and have preference over common shares. But it is definitely possible. If you do want to go into that segment, I would look for some of the biggest players in the game, ones like Hilton. But you have to understand that if this keeps going on,
a lot of these companies are in huge trouble. So I would not put a big percentage of my portfolio into that segment of the market.
Well, and you were talking earlier about capital investment that businesses would need to make.
Yeah.
Certainly, it's a huge capital investment to throw up a hotel. So
Yeah.
definitely
right.
something to watch there.
Yeah,
Question
that's right.
from Jim, who is probably a regular viewer of our live Q&As, because he asked, is Bill Mann still holding Stage stores that he recommended a while back?
Ouch, that's painful. So no, I actually am not holding Stage stores anymore.
Remind me of the business.
They were a company that was making a transition into low cost retailing.
That's right.
Very soon after we had our we had our discussion, the company came out with earnings that were literally terrible, and just got kind of overrun with credit issues, and so definitely the coronavirus has not helped them make that transition into off-price retailing. They may actually come out on the other side, but it was a situation where gosh, I hate even talking about this at this point, but it was a situation where the company got really overrun by subsequent events, and yeah, it's a little bit painful, but no, I've moved on from it.
Great question from Emma, who asks, can I make money with only $800? I'm a student, so I don't have much to invest with. Great that a student is looking to invest, and I'll just point out, the name of this video is Where to Invest $1,000 Right Now. So you're basically there, Emma.
Yeah.
But I think, Emma's question speaks to one of the great myths about investing in the stock market that still persists to this day where we have $0 trading commissions, and that is you need a lot of money to invest.
Yes. Now, the answer is a little bit twofold, because if $800 is all you're ever going to put into the stock market, it's really, really hard to suggest that you're going to make a lot of money doing it. But if you are getting started, and Emma, I believe you said, was a student, you have almost all of your earnings coming ahead of you. Absolutely. Now, what we can't tell you is that things are going to be better tomorrow. I mean, it's just completely, it's impossible, and I wouldn't trust anyone who comes out and says, yes, we've hit the bottom, because we don't really know. But if you are looking to put a little money to work in the market now, the prices that you're getting now are so much better than they were even a couple weeks ago. So yes, absolutely. An $800 start is a great place.
A question from Dakota that speaks to a topic we touched on earlier. I've read some companies are cutting dividends and more will follow. I know this is not ideal, but probably necessary to save cash. Mm-hmm. Do you think this will further push stock prices down? Great question, particularly when you consider we haven't really talked about funds, but there's all manner of mutual funds out there, including funds that focus exclusively on dividend payers.
Yeah, it may, but keep in mind that that the Fed funds rate is essentially zero now, so companies can cut their dividends and still have an income preference over what you can get in the debt market at this point. So yeah, it probably will affect them. I think by and large that people have the understanding that what's happening now and the reason that companies are doing it is due to an exogenous risk. You're not talking about something that is impacting one company. It's impacting everybody. So yeah, I would assume that there's going to be a lot more. It may be painful for people who are looking for income from dividend payers, but in some respects, where else are you going to go? Right, it's not like you can get much from a CD. They're essentially paying zero now.
Eric, who is starting out just like Emma, I'm just opening an IRA and I want to buy an allocation of ETFs. What are some ETFs that you would recommend?
Some of the ones that I would recommend at this point, we were talking earlier about how the U.S. stock market is not necessarily all that cheap. When you're talking about that, in general, you're talking about the S&P 500, which is the largest 500 companies. There are ETFs that track the smaller segments of the market, the small and mid caps, and the mid cap the mid cap ETF is ticker MDY. It's and it tracks companies that aren't in the largest 500 companies. And what we have seen is that the market now is a little bit separate. Like, so just for example, today, the S&P 500 went up 1.4%. The Russell 2000, which is 2,000 smaller companies, is up 7.5%. So there is a lot more, there is a lot of opportunity, and there is a lot more, it's a lot cheaper in the smaller segment of the U.S. stock market.
Question from Erko, who writes, greetings from Finland. Thank you for watching.
Fantastic.
Would your answers to today's question be the same if you were talking about investing $100,000 instead of just $1,000? Would the basic rule remain the same regardless of the investment amount?
Essentially, what you have if you were investing a larger sum of money is the opportunity to take a little bit of the time risk out of what you're doing. And by time risk, I mean if you have $100,000 to invest, I'm assuming that you're not a billionaire. So if you have $100,000 that's free and clear to invest, but you're worried about the stock market dropping over the next couple of weeks, what you can do is set up a plan and say, I'm going to invest $20,000 today, and I'm going to set a timer. So 2 weeks from now, I'm going to invest $20,000 more. 2 weeks after that, $20,000 more. The thing that people need to remember when we're talking about the stock market, it is one of the very few places where when things go on sale, people run away. And we are hardwired to do it. So yes, any amount of money that you are interested in investing now is great. Have a plan.
Great question from Deborah. What do you think about buying shares of Walmart, Target, Costco, CVS, and other stores right now that are profiting from coronavirus? I think what she's asking about is, should I invest in hoarding? Because when I think about those
Kimberly Clark,
when I've walked through the grocery store, when I've walked through CVS, there are entire aisles that are just empty shelves.
The giant store by us looks like what I would imagine Venezuelan stores look like. I mean, just absolutely stripped clean. Apparently, I can't confirm this, but Walmart is taking a huge share of the grocery delivery business. So much of it, is upward of 50%, I've been hearing, is coming from Walmart. And I would never suggest that that you go out and you invest in hoarding, right? But I would say that it is certainly possible that people who are starting habits now will continue doing so once things return to normal. So things are definitely not normal now, but Walmart is it's a great company to start with, but it may be, at the end, at the end of the scare with COVID-19 that people continue shopping online and using grocery delivery from Walmart.
Well, and you talk about habits forming. I mean, that's certainly an opportunity to go back to entertainment. Businesses like Netflix, Disney Plus, Hulu, Amazon Prime,
That's right.
More people spending time in their homes.
More
Zoom
as well.
More binge watching.
Yeah.
Question from Beth. How do we keep calm during this storm? I have seen thousands of dollars disappear from my portfolio. Beth, you are in good company, I assure you, because I've seen thousands disappear from my portfolio, and so has Bill.
No, I'm just kidding. Don't keep calm. There's no.
Don't keep calm. That's your.
I'm not
advice?
saying. Yes, exactly. Now is the perfect time to panic. What was that, Monsters Inc.? I guess.
Yeah.
No, there's no reason to suppress the fact that what is happening right now is scary, right? Just embrace it and understand that everyone is scared. Even the people, you go onto Twitter and you see people say, "Oh, it's a great opportunity, buying opportunity." They're still scared, right? The real key is that even though you're terrified, buy anyway, right? Really come up with a plan and be as unemotional as possible when you are executing it. Which is why I suggest, if you're really worried, you're trying to put some money to work, set a plan. So you buy a little today, you buy a little whatever, a month from now, and you just do it that way. You know, the people who ended up getting hurt the worst in 2008 and 2009 were the ones who couldn't take it. And I'm not saying that this is, you know, that this is the exact same as 2008 and 2009, but we have recovered from every problem that we've had in the past, and we will recover from this as well.
Great strategy question from Paul, who asked, would you prioritize adding to a position that is down big or a position that has largely held up over the past month? I think the first question I would ask is, I would want to know why. Like, you know, and by the way, if there's a good reason that stock has held up over the past month or so, then yeah, maybe that's the one to add to.
Yeah, I think that the market is actually showing us, although almost every company is down, but the market is showing us the companies that are less fragile than others. So I actually kind of would focus on companies, and the three that I recommended, they're, you know, two of which are down pretty sharply from their peaks. I would really more focus on companies that have, you know, that have low cash needs, even if their business looks bad in the, you know, in the interim, and don't let the stock price be the thing that guides you.
Question from Jamal, who asks, greetings from a fool in South Africa. We've got the international audience here. It's fantastic. What does Bill Mann think about Visa, and has it fallen more than was necessary?
Yeah, both Visa and MasterCard are absolutely fantastic companies. I think that they are in a range where they can be bought today. I would have been buying them in February as well. I mean, at the end of the day, and Jason Moser, our colleague, has talked about the war on cash. I think that one of the things that is going to come out of this is that cash is going to be less and less of a means of transaction as we go forward. So companies like Visa, which take a little tiny piece of every single non-cash transaction, are absolutely great places to look for some value now.
We've talked a little bit about China. We've gotten questions from Finland and South Africa. You're someone who likes to look literally around the world for investments.
Yeah.
What is one other region investors who are watching should look at? Because I think most investors in the United States tend to just focus on the companies here in the U.S. Makes sense with the thousands of opportunities in the public market. But what's one area outside of China where we should look as investors?
Any place where there is a dramatic increase in the in credit. In credit transactions, there are markets like in Latin America where it is primarily a cash-driven society, but you are seeing, in Latin America, you've got Mercado Libre, you've got StoneCo, you've got companies that have been hit very hard because they provide services to small and medium enterprises, but in the longer term, I think that is to get back to the same point I just made with Visa, an area where there is going to be a sea change as we come out from this.
We've gotten a couple of questions about blue chip stocks, specifically BP and 3M, both beaten down, both blue chips for a couple of decades, if not longer. Do they look attractive at this moment?
I would prefer 3M to BP for the exact reasons that we were talking about. The oil patch, beyond everything else, beyond the drop in consumption that is happening worldwide. You've got a price war that's going on essentially between the Saudis and the Russians. The agreement that was in place, what they called OPEC Plus, has fallen apart. So there are some real geopolitical issues in the oil industry. If you are interested in participating in the potential rebound, of the energy industry, BP is a good place to start. Royal Dutch Shell, Exxon, the companies like that. But I think that I always get a little bit worried about commodities, and then commodities that have a geopolitical risk built on top of them, and there are none that are have that more than the oil industry. So I would say between the two, 3M is my preference.
Last question before we wrap up. We're seeing all these news stories about the reduction of pollution since the coronavirus shutdown. Would it be smart to invest in companies that are helping us go green? Certainly a long trend.
Yeah. I saw actually today that the nitrous oxide readings in China have actually gone back up a little bit, which will show, the factories are starting to work again. I don't know that there's a link between what's going on now in the green industries, but I think I was actually thinking about this earlier, and think about this, live now. Like, what learning are we going to get from the fact that pollution has dropped so quickly, around the world as a result of the shutdown from the coronavirus? And what types of technologies are we going to look to and say, this is where we need to go? I don't really have the answer there. Next time I come on, I promise I will have thought about it more.
All right, Bill Mann, thanks for being here.
Thanks, Chris.
Thank you so much for watching. Again, thanks for the thumbs up, and don't forget to click the subscribe button so you can check out all of the stock market Q&As that we do here on the Motley Fool's YouTube channel. I'm Chris Hill. Thanks again for watching. We'll see you next time.